Hello and good evening, everybody. Welcome to today's webinar, Private Equity Approach to Small Cap Investing, hosted by CFA Society India. I would like to take a moment to welcome our audience from around the world joining us remotely. My name is Vaibhav Jain, CFA, and I will be the moderator for today's webinar. Today's workshop is scheduled for 60 minutes, including Q&A. We'll be leaving some time for the Q&A after the session. Please feel free to submit your questions throughout the session. You can do so by clicking on the chat link at the bottom of your viewer and typing your questions in the box. We value your feedback, so please complete the evaluation survey as well before you sign off for today. Now, it is my pleasure to introduce our speaker for today's webinar, Mr. Sandeep Daga. Sandeep has almost 3 decades of experience in financial markets, primarily in public and private equity investing. Sandeep founded 9 Rivers Capital in 2008, and they launched their flagship small cap strategy in December 2012. So it's been almost more than 9 years now. In FY 2021, their small cap strategy was the best performing PMS with aggregate returns of 203%, making them chart toppers across all PMSs and AIFs. Sandeep has been an astute investor known for spotting investment trends and high performing companies early on. Prior to 9 Rivers, Sandeep was a partner at Frontline Ventures, a growth PE firm focused on mid-market investing. He was also head of B2B investments at ICICI Ventures, and prior to that, he had a career in corporate finance across reputed companies. Sandeep holds an MBA in finance from NMIMS and is a graduate in electronics engineering from Amravati University. So happy to welcome you, Mr. Sandeep. And
Thank you for those kind words, Vaibhav.
Thanks, Sandeep. So Sandeep, over to you now. So if you have the PPT, you can share the PPT and then we can start.
Sure. So I'll share my screen. Vaibhav, can you see the presentation?
Yes, I can see the presentation. Go on, sir.
Okay, great. So good evening, everybody. Sorry, I'm going to take your time when it might be the time for you to actually go out and kind of unwind yourself. So my attempt would be to make this entire talk worthwhile for you to spend this evening time of yours with us. Also, I do hope that just a second. Just a second. Vaibhav, is this clear? Can you see it?
Yes, it is. It is clear, Mr. Daga.
Great. So, I do hope that today, through this presentation and some of the discussion or Q&A that we have, thereafter, I hope that, I'm able to leave with all the audience with some thoughts that they can carry and ponder over and bring some new dimension to how they look at investing in equities and especially small caps. First thing first, we start with a disclaimer that, any company or stock that I refer to during this presentation as well as any Q&A thereafter is only for illustration purposes. It is not, and I repeat, it is not a recommendation or an advice to buy or sell. So as you see, this title of today's presentation, Vaibhav, it also happens to be the tagline of our small cap PMS. When people say what differentiates us, and we say, that's the private equity approach to small cap investing. And often we are asked these 2 questions, which I believe are intertwined. Why small caps and why private equity approach to small cap investing? So I thought, as we get into, more details about our approach, we should also first address why small caps in the first place, because there is this whole debate about, the comfort and the safety of large caps. So did you know that a bunch of current Nifty 50 stocks were small caps less than 15 years back? Oftentimes when I ask these questions, people just look up and they just kind of, say, is it so? And that's where, you end up, sharing some data points, which I'm going to share here. And that's just a second. I think I was having some technical issues with the sharing. So here we go. 5 of our current Nifty 50 stocks were actually small caps just 12 to 15 years ago. And it's amazing that how often we don't, look back into history, but these are names which are commonplace today. Each one of us, we can associate with these names. We always talk about how these companies have, what kind of CAGR returns they have given. Obviously, they are presented here. They are phenomenal returns over 12 to 15 year period. But friends, these were all small caps just 12 to 15 years ago. And that's why, I don't have to say why small caps. Small caps, some of them, select small caps, I should say, go to become large caps and go to become Nifty stocks as, as we, over long periods of time, and they can really become big compounders. So that's how, and then what happens is that it's not just these stocks. There are many small caps which have seen decadal growth and have become, large caps. And some of them, these names that you see on the screen now, may even eventually become part of the index, Nifty, over time. We don't know. So that's why investing in small caps, despite the fact that they are considered to be risky and a volatile universe, and you have to endure illiquidity, you have to endure volatility, but good companies do tend to outperform and do become part of larger indices, including Nifty, over longer periods of time.
Sandeep, so sorry to interrupt, just one point. Because of the technical glitches, the CFA Institute has taken the control of the panel. So just let us know when we should move the slides.
Sure. So go to the next slide now. Go to the next slide. So now coming to our, subject today, what is this private equity approach to small cap investing? And what I would like to do is, I would like to answer this question through an illustration. I think that's a very good way to kind of make everybody appreciate what we mean by the private equity approach. Go to the next slide, please. So here is it. These are actual numbers of a company that we looked at sometime in late 2018. We are, by the way, still invested in this company. I want to kind of throw a question to the audience. Would you invest in this company? As you see this, from 5 years prior to our looking at this company, there is a very tepid revenue growth, if at all, falling EBITDA margins, obviously falling PAT margins, falling return ratios. Perhaps the only thing which is like a silver line is that their working capital cycle has become better over these last 5 years. Even the fixed asset turnover has fallen. I should also say that at this point in time, there was no sell-side research coverage. One of the company's main customer segment, where almost 70% of the company's revenue was coming from, was undergoing financial stress. And obvious, as you see these numbers, these are real numbers. Historical data would suggest that this company is a complete no-no for investment. And nobody would like to look at this company, at least looking at the historical financials. Go to the next slide, please. Now, when it comes to the private equity, and I've had a private equity career, you would take a deep dive into the business. You would do kind of a 360-degree evaluation of the business. A lot of it is, beyond desk work, like 30% is desk work, 70% would be, you go and do your homework on the ground. What did we find out? So through the deep dive, that there are policy tailwinds setting in for this business, both locally and at a global level. This company is very well respected and is the undisputed leader in its offerings, and again with a global footprint. In fact, this is a company which is a leader, which has almost like a 60% market share. The next guy is not even half its size. It has a strong balance sheet, no debt. In fact, what we realize is that there is a lot of cash on the balance sheet, and therefore, the return ratios are also looking very suppressed. It has a demonstrated technological prowess in its line of business. As I said, it has a global footprint, so not just in India, but across the world. There are new business segments that the company has added over in the last few years, and these are growing healthily over a low base, obviously, because they entered these segments. But the addressable market for these segments is also very large. So over time, the company has actually moved away from being dependent on one large sector, and now is targeting some very good healthy sectors. Also, what one realizes is that there has been these organizational revamp that the company has undertaken in the last few years, and clearly it points that this is being done keeping in mind that there is a high growth phase that is likely that the company is likely to endure. So this is where we picked up these clues, understood the space, kind of modeled the future in our own way, and where the larger market perhaps saw a dead horse, we saw perhaps a horse that is reborn and ready to gallop. So that's what this is what perhaps what we mean by a private equity approach, that you basically try and anticipate and envisage what's going to happen in the future. Go to the next slide, please. So what happened since then? So we have numbers until financial year 21. You can see that how the revenue growth has come, how the EBITDA margins have improved, obviously resulting in PAT margins, slight improvements good improvement over base, but still not, optimal. You can see the return ratios are becoming better and better. And then you have, all the parameters that are improving. Our own anticipation is, so these are our estimates, and mind you, these estimates do not factor in the recent, geopolitical developments and the cost pressures, inflation, commodity price inflation. So there our numbers can go haywire, our estimates, but these are our numbers and what we estimate, over the next 2-3 years. So this is what has happened. The core business has got completely revived. Brisk order inflows, much more than what we projected. Macro policy tailwinds, which we always saw, have become even more stronger. A dynamic go-getter CEO came on board, and since then things are looking, in terms of the company's direction and what it is, the new initiatives that have taken have all been very positive, and therefore we have a winner. So if you can go to the next slide, I can unravel which this company is.
I was just asking people in the chat box that if they can guess the name of the company, but here it is.
The company you are talking about is Praj Industries.
Yeah.
So, what was the investment thesis? So it all started with when India signed the, Paris Climate Accord. We said that now India needs to take decisive steps in reducing the carbon footprint, improving all the whole environmental goals have to be fast forwarded. One of the low-hanging fruits was to improve the blending of ethanol in our fuel, starting with petrol, and of course, and this is all petrol, diesel is still to happen, from 5% to 20%, for which, by the way, policy existed from 2003. So a policy paper to do this existed from 2003. It is only after 2016 that really the emphasis on this policy, after we signed this Paris Climate Accord, we felt that now this is the lowest hanging fruit. Also, this is Vaibhav, good economics and good politics coming together. The biggest producer of ethanol is sugar industry, and sugar industry was going under a duress. Our public sector banking system was sitting on huge amount of sugar NPAs. So what ethanol blending does, if you improve the ethanol blending from 5 to 20%, the first thing that the government, we thought that the government will do is to say that no more only molasses, you can use sugar juice straight to produce ethanol, because there is no shortage of sugar in the country. The moment you do that, the government doesn't have to go and buy sugar from the cooperative mills and store it in its godowns. The government, doesn't have to delay payment to the farmers based on the MSP that it sets up. Because the ethanol gets blended into fuel day 1, day 2, the fuel is sold, day 3, the money is realized by the government. So the whole cash flow cycle for the entire value chain simply crashes from months or years together, which was the case earlier, to only few days. And that's what has happened. That's what has led to, the sugar. I mean, everybody knows what has happened to the sugar industry in the last 3 years. From being in distress, now they are churning out record profits. Praj is the leader of ethanol plants. From 5 to 20%, if the blending had to go, then you required to quadruple your ethanol making capacity, which was simply not there with the sugar industry. The government obviously fast forwarded that goal. Earlier they said we will do the 20% blending up to 2030, which was fast forwarded to 2025. So you would have read few days ago, we have barely reached 10%. It's still less than 10%. So in the next 3 years, we have to reach 20%. And now we are talking about adding diesel. So these were not anticipated by us. So this is what has happened with Praj. And, this is what we call as the private equity approach, where when we bought, as you can see, we bought at around 80-85 rupees. I know I spoke to my friends from the public market fraternity and everybody told me that, what have you bought? There is no growth. I mean, all what I spoke earlier. And when I spoke that, okay, this is the big ethanol opportunity that is coming up, everybody was skeptical. Why I'm saying this is because this is where also the private equity approach is not just about, discovering a theme. You also have to be patient with when this theme will play out. It can take several quarters to maybe a couple of years. But this is how the private equity approach works. And this is how we apply this private equity approach to small cap stock picking. Go to the next slide, please. So the private equity approach constantly nudges or pushes us to look beyond past numbers and anticipate the future of a target company overarched by a positive industry or sector tailwinds. Go to the next slide, please. This was just to kind of summarize what the private equity approach is. What are the key tenets of our private equity approach? First thing is that we endeavor to catch an investment thesis early on. Obviously, the whole idea is that you want to make the most of the discovery premium, but as I said, it also requires patience, and that patience gets tested often. So be it digital transformation, be it financialization of the economy, be it direct benefit transfer of subsidy and its impact on certain industries. We've been able to look at as this was happening early on and participate in different companies at different points in time and reap the benefits of being an early entrant and catching an investment thesis early on. What this requires us is also to build industry expertise in certain industry segments, and that requires us to be constantly on our toes to kind of go and interact with various industry participants. And it's not necessary that you will have a investment opportunity every time you are building an industry expertise or a certain expertise around a certain theme. So for example, today we are gaining and trying to understand the entire plant protein industry. We don't have an investable idea as yet. We don't even know whether we will have one, but we know that this mainstreaming of plant proteins is going to have a big impact on the global supply chain of the meat industry, be it in India or abroad. And that means that go down to the keep going down into the supply chain. Many people are going to be impacted. Some of them positively, a lot of them negatively. This is what is a constant endeavor at our end. Me and my team, we are a kind of a learning organization, and that's what kind of ends up with investable ideas from time to time. But sometimes you may even say that, okay, I did all the homework, but in the small cap space, there is no investable idea. We invest for the long term. Our average holding period is typically 5 years. Given that we we operate in a listed market, sometimes we may end up selling in 4 years and sometimes 6 years, but average holding period is 5 years. Very important is we buy growth, but only at reasonable valuation. Now, this is easier said than done because, the more traditional way of operating any fund is to have a model portfolio and replicate the model portfolio across all clients. But especially in the case of small caps, we believe that is not the optimal way of doing it, because a model portfolio forces you to buy underlying stocks at whatever valuations they are trading. And as all of us know, that small caps have very high volatility. So if you end up buying companies at extremely high prices, you can actually see significant drawdowns. We've seen, we know that this is a universe which is subject to very, very high volatility. So what we have is we don't have a model portfolio. Each stock has what we call as a guardrail price, and we don't buy those stocks above those guardrail prices. So, two clients who come at the same time will have the same portfolio, but one client who comes today and one client who comes say 6 months from now, there could be some minor changes in the portfolio of in terms of some of the stocks of the older client would have run up to a level where we are not selling, but we are not buying either. As is the case in any private equity portfolio, you have to be comfortable with a concentrated portfolio, because all what we do, we build a lot of conviction around the companies that we buy. Then we want to put some good money to use in each of those companies. So typically, our companies have 15 stocks, and we invest to exit. Unlike many public market investors or fund managers would say that as long as a company's thesis is on the as I want to invest in a decadal or a 2-decadal compounding story, we follow the same private equity approach, where in a fund, in any private equity fund has a fixed life. You invest in a bunch of create a portfolio of good companies, each with a strong investment thesis. As the thesis plays out, you exit. So it's the same philosophy that we have. So we invest and we exit, as I said, typically in 5 years. And I have a slide to share later on exit, why that's the case for small caps. Go to the next slide, please. So what do we look for as a top-down while we build a thesis? Because I've spoken a lot about identifying an investment thesis early on. So the first and the foremost, and one of the ways to build a thesis that we look for is we look for macro tailwinds. Industries or industry sub-segments that are likely to witness multi-year structural growth on account of tailwinds that are available. So the important point to emphasize here is structural growth. We would want to see what are the drivers of the structural growth and appreciate those drivers. So taking, for example, policy and regulatory tailwinds. We spoke about ethanol blending. Now the advent of RERA, followed by, so actually it's for, starting with demonetization, followed by RERA and followed by GST, has changed the character of the real estate industry in India. And which means that, more organized, well-funded, strong, robust balance sheet players have a distinct advantage over, over the more unorganized or a more, shoddy players who always swamped the real estate market. So that kind of is a structural thing in nature. We all know about China plus one, we know about PLI, and how that is likely to be having a, long-term impact on India's manufacturing. Green hydrogen is I'm sure everybody has heard about, but we are right now, as we speak, again, we don't have any stock which is a green hydrogen play in our portfolio, but we are studying. But we do believe that this is structural in nature, and especially from India's perspective, this is going to be very, very important driver of our energy needs going forward. Demographic, we all know, demographic tailwinds keep coming from time to time in different forms. Sometimes it is some industry subsegments and some consumer subsegments. Sometimes it is like for financialization of savings, we are underinvested, we are underinsured, we are underbanked. So these are things which obviously everybody looks at. We also look at, and we also figure out, what is it that we can back from the standpoint of an early discovery of a theme. We also have a certain bias for tech-driven tailwinds. So what was IT services earlier, today we have Indian companies who are now moving up the value curve, where there a lot of IP development is happening either by way of cloud or SaaS offerings. We have a lot of analytics companies which are now riding on the back of AI and ML capabilities. And more. I mean, the kind of VC funding ecosystem that has evolved in India, and the kind of VC funding that is now coming from Silicon Valley VCs directly into Indian companies. If that's a pointer, we will have true blue product companies, IT product companies, tech product companies coming out of India. And tech goes beyond IT into telecom, into defense, so tech is not just IT, but healthcare tech and agri tech. The backbone may be IT, but it goes beyond IT also. Then the many of our investment ideas came from first looking at transformative management changes that have been happening in certain companies or certain businesses. So either younger generation which is coming with a different exposure, taking over the management reins from the older generation, or professionalizing of management that is happening, has led to the companies changing orbits in terms of its growth plans, and in terms of becoming more growth oriented, more shareholder value oriented, and that kind of also plays out very well. So we keep looking for maybe I can give a few examples here. Vinati Organics, when the baton was passed on to Vinati, we know how the company has done in the last many years, and that's how just that younger generation and the dynamism coming in completely changed the growth path for the company. We were invested and we have exited in Escorts. We saw that how the managerial changes in Escorts led by Nikhil led to a complete revival, not only a revival of Escorts from a situation where they were under duress, but complete going on to a going on to a high growth path, and also becoming innovators in launching new products which have a worldwide appeal. Likewise, we've had several experiences ourselves of investing where management transformative changes at the management level led to this kind of growth. And then, of course, we also have always are on the lookout for disruptive business models or trends and its likely impact. And this is not just in terms of where to invest, but equally or more important, where not to invest. So we all know about advent of electric vehicles and autonomous vehicles, and how it is now already disrupting the supply chain. Plant proteins I spoke about. Very important, this is again we are studying right now, is that the extended producer responsibility for recycling of packaging material is now has become a law, and it was there elsewhere. Now it is become a law in India also, and it is basically in a phased way. All the big consumer companies, be it on the on the food side or be it on the FMCG side, all of them need to take this responsibility of managing the packaging waste that gets generated. Now this has again implications both positive and negative for certain businesses. So this is how the thought process. Now, if you ask me today, do I have a stock idea ready where I'm invested, or I'm wanting to invest shortly? No, but we know for sure that this is going to have implications, and we may end up finding something interesting to invest. Next slide, please. So what do we look as a bottom up in any company that we invest in? Obviously, we want a solid business franchise. Businesses where with proven brand and an execution capability. The business should have a leadership position within its niche. And generally, we also look for, there is some innovation quotient in the business. Either, you're coming out with newer products, going into newer markets, etc. So something which gives the company a certain edge over the competition. Now, just to give an example, when we invested in Praj, we also knew that the sugar sector is going to be a very big beneficiary of this move of ethanol blending. But we preferred Praj because we could clearly see more of a structural growth that can happen. And here is, whether you efficiently, whether or not. When I invest in a sugar company, I still have to endure with debt. I still have to endure with management quality in most sugar companies. I still have to get my comfort around, how efficient a producer you would be. But here was a company with, when I say solid business franchise, here is a company with solid execution on the ground, leadership, great management teams. That's what we mean. Within a team, you can have several players. Our desire is always to get with a solid business franchise. We are for profitable growth. We are not for mindless chasing of growth. This is something which is us. It's not that every private equity approach needs to be this. As you know, in today's world, a lot of VC funding is happening to burn capital, and some of those companies are now getting listed in the markets also. But our thing is that when it comes to small caps, you need to have profitable growth, is what we believe, and therefore we have we are okay investing in companies with, say, moderate sales growth, which is anywhere upwards of 15-20% compounded growth profile if you have. But the earnings are either keeping pace or growing more and having they're having a growth which is more than the sales growth. So that's what we look for typically when we look at companies which we want to invest in. We do want to look at operating leverage. If not all of our companies, we see that there is one or the other operating leverage at play. It could be sweating of hard assets, or it could be soft assets. Both ways, the multiplier effect can be significant. We basically are for low or no debt. So we look for very low financial leverage. But actually, if I tell you, most of our companies are zero debt. There is no debt in most of our companies. And the idea here is that small caps, relatively smaller in size, and if for God forbid, if you hit an adversarial business cycle, then those companies can come under severe stress. Statistically speaking, it actually applies to all caps, but I would still restrict my argument to small caps. Any small cap company with high debt, whenever it hit a adversarial business cycle, or whenever the markets peaked out, there has been a decimation of equity value for those companies. I'm not saying the companies die; they will survive. They will, perhaps work for all their lenders, their suppliers, but the equity value gets decimated. So why even go in that direction? So we've kind of stayed away from any, companies with fragile balance sheets. We only invest in very robust balance sheets. Lastly, we look at companies, and as I said, we want to anticipate and envisage the future of the business. So we want to see companies and businesses which have the potential to generate healthy return ratios and free cash flows. Now, we have come across situations where a certain business generated free cash flow for last 2-3 years. But if you were to go back a decade and kind of do a cumulative free cash flow analysis, one saw that there are 2-3 years when a company does very well, because the business is of that nature, and then after that, you have negative cash flows because the working capital cycles get stretched out. So for us, it is the potential and also to understand the nature of the business where you can cumulatively keep generating free cash flow rather than spurts 1 or 2 years, and that happens in certain commodities as well. This is what we look for, when we look at a company. We can go to the next slide. We've always, this question gets thrown at us, corporate governance in small caps, patchy, many times. So some bit on corporate governance. So first of all, we do believe that when we invest for the long term, we should not look at only corporate governance. We should kind of, look at a company from the overall ESG perspective. So we are not an ESG fund, but what kind of attributes, we are there in a company that you're looking from an ESG perspective. And, especially for certain types of businesses, for example, if you were to invest in specialty chemical companies, agrochemical companies, pharmaceutical, API manufacturing companies, then, respect for environment is very, very, very critical, because any mishap can kind of, lead to a plant closure. And therefore, the E becomes as important as the governance in those companies. The companies which kind of employ a large workforce, textile, garmenting, IT, BPO, then how inclusive is the workflow. I mean, is the work people environment? What kind of policies, especially manufacturing businesses, they have towards employee welfare. All this becomes important not just from the standpoint of business disruption because of any union and strike, but also we have seen very clearly, and we have established this statistically when we were studying textile companies, that companies with very, very inclusive work environment for people, their productivity and profitability is better than the companies which kind of fall short on that count. So when we invest for the long term, this becomes an important parameter to look at. And then, of course, good corporate governance framework and track record is very important. That is universal, applies to all companies. Now, when it comes to corporate governance, it is not one yardstick that we can use, that just look at their past management actions and if there is any red flag there. For us, it's like a combined assessment, based on, of course, starting with past management actions, and then we do ref checks on the leadership. These are all informal systems, and we kind of get our hang around systems and processes that companies have. So, for example, we've come across certain times companies, good businesses, good people, nothing, but a 1,000 crore revenue company, for example, still working on Tally. Now, that is in our mind, that's also a governance issue, that you're not planning towards the scale. You run the risk of tomorrow, not being able to take effective decisions because your MIS maybe. I have nothing against Tally. I'm just saying that you need to migrate from a basic accounting software to a SAP. At some point in time, every business has to, and that leads to better decision making. That's also a part of governance. Of course, how do you communicate with your minority shareholders, especially when there are adverse events, and adoption of, how the accounting practices are, what kind of, disclosure standards are there in the books of accounts. All of this leads to what we call as overall governance, and we kind of have a, score. We score governance on a scale of 10. And important thing is that, so our cutoff is 6 on 10, but for us, it's important that we see that a company which we approve as 6 on 10 governance, and ultimately, if it's 6 on 10, then you will obviously factor in a certain valuation for that company. 6 on 10 is tending and trending towards 7 on 10 is great. But at 8 on 10, we invested in that kind of trending towards 7 on 10 because of any dilution is not acceptable. And I can tell you that we have exited a couple of such companies only on that count. We made money, but we saw that dilution of governance and we have exited. We can go to the next slide. As I said, I have one more slide on the importance of booking profits in small caps. So as we invest to exit, and our typical time frame is 5 years. Why? So here is the reason. We invest in a portfolio of small cap stocks. As you can see, the listed universe is a pyramidal universe. Of course, there is an avoidable universe, which is your penny and tiny stocks. But thereafter, there are a large number of small caps. Few graduate to become mid caps, and even fewer graduate to become large caps. When we invest in our companies, we all see a growth potential, which is for the long term. We see a good management team, all the attributes that you look for. Yet, history shows that, some of them will be able to jump the orbits, and a lot of them may kind of, hit a saturation point from where either they will degrade or they will remain there for a very long period of time. They may not be able to make that next jump. So for us, we don't know which one of our companies can really become a 2-decade compounder, or a 20-year compounder, or a 10-year compounder. For us, it's that there is a certain thesis. The thesis is playing out. The leadership team has kind of delivered the growth that we anticipated, and there comes a time we should exit and perhaps look for another another similar company with a different thesis, and play the theme again. Play the new thesis again. So that's the reason we believe small caps are best played through exits when a thesis that one invests with plays out. In retrospect, we know that some of our companies which we invested in the last 9 years may become large caps and may enter the indices, but we don't know which ones. So we kind of exit. And as I was telling you, good small caps, and when I say good, means these are small caps which fit our bill. From the peak, they can correct a lot whenever the markets peak out. We've seen 30 to 60% correction, and these are good quality small caps. So that's another reason why you should treat the private equity approach of building a portfolio, let the thesis play out and exiting the portfolio, or actually more than portfolio, investing in a company, let the thesis play out and exiting a company is perhaps a more prudent strategy to invest in small caps. Go to the next slide, please. Just a few case studies again to kind of say how we've thought like a private equity investor and how it has led to returns for us. So I spoke about digital transformation. 4 years ago, we've even published our thoughts in our quarterly updates. So we kind of became very bullish on digital transformation, needs for the global BFSI sector. We attended calls of some global tech companies, and they were speaking highly about how the whole digital transformation is a big opportunity for them. We attended calls of global banks, and they spoke about how digital transformation will make them reduce the cost of customer acquisition, have better customer retention because of one single screen digitally where you can do everything that you do with a bank. Although the systems behind are very different, so insurance is a different system, investments are different, core banking is different, lending is different, credit cards is different, but on a single screen, how digital transformation will make, and that was the whole opportunity. So we clearly knew that there is this opportunity, and then we obviously, the big IT biggies of India were not our universe, they were all large caps. So we looked around and we found a few companies that we have invested in the digital transformation. One of them is Intellect Design. Now, important thing was that Intellect had a suite of products which were basically sold as license, which sat on the core banking system, and they had a clientele which was not just in India but in Southeast Asia, in Middle East, and they were just about entering Europe, and they were also having plans to later enter the North American market. So when we invested, primarily the revenues came from the license model. However, the company was undergoing undertaking an investment cycle to build a complete cloud stack of their offerings. And this, would mean that, over the next many quarters, while the cloud stack is built up, the company would have depressed EBITDA margins, how much time it would take for the cloud business to take off, and for onboarding of a large number of cloud clients who would, pay them on a SaaS basis is, was unsure. But after doing our homework, And after speaking to people on both sides, we realized that the adoption to cloud is a reality. Is going to happen, and we were actually quite comfortable with this investment capex cycle that company was undertaking. And actually, the street was quite disappointed. So as you can see here in the chart, after we invested for a fair bit of time, we had to be quite patient. Somewhere, and then of course, post-COVID, there was a temporary big fall in the stock price. But since then, we saw that the cloud adoption has happened much faster than even what we anticipated, even the company anticipated, honestly. And all the investment that they upfronted today has paid off. So the company has actually grown from strength to strength. Every single financial parameter that you track from standpoint of growth and profitability, the company is becoming better every passing quarter. And we do believe that Intellect, in its niche of offerings, is amongst the global top of 4 or 5 companies, and they have a global clientele today. Not just they have gone to Europe, they've even now cracked North America. So that's how the earnings J curve has come. But we did anticipate this kind of a J curve, and that's what made us invest. And that's what again, the private equity approaches. But also our patience got tested along the way. We are about 6x or 7x in from where we invested in the last 4 years in Intellect. Next slide, please. So Tejas, now this is an interesting case. I picked up this only to again say as to how we. So when this is our first post-COVID pick. So when COVID happened and when there was a fall, now just before COVID, there was already this whole anti-China built up in the West that was happening. And there were concerns around Huawei, and it's, Huawei was being kind of shunned by the West and also by the East, by Australia, by Japan. And that's where when COVID happened and the need for, network expansion because of work from home and remote working happened, we felt that Tejas as a company, which again, if you go back, it has had its great growth period. Then it fell off the cliff where the company didn't go anywhere for many years, almost 4 or 5 years. But we said that here is a company which has all the products which go into the last mile connectivity for providing internet bandwidth inside homes or offices. It also at the carrier level. So it's not at the modem level inside, but last mile connectivity before the bandwidth enters any home or office, but at the last mile. And they also over time had, because they were dependent on Indian BSNL business, which was where orders were not flowing, there was a lot of sticky receivables. So they were reinventing themselves in the meanwhile by expanding their product offerings, hiring people in different geographies. So all of that was in place and COVID happened. So we could clearly see that here is a company where macro environment has improved because there is no Chinese competition. And there is going to be a huge demand for their products, and they already have people on the ground. They have distributors that they had appointed in the last few years. So without having any visibility of where how much growth will happen, where it will come from, but clearly the macros being very supportive and all the actions on the ground, we took this call of buying into this company, but we bought at an extremely attractive valuation. The valuation was equivalent to the cash in the books. And since then, of course, not only the company has seen again, business picking up in different geographies, orders flowing through. It was a complete surprise for us when Tata's bought the company, and now it has become a Tata company. Now, what that does to this company is that globally, the only risk that this company faced perhaps was it was a small company. So, big guys may not want to deal with you because will you survive? Will you be there to service me? All that fear is now gone. So we do believe that, this company will continue to do well and under the Tata, banner. And again, we are sitting, as you can see, our enterprise was so low that we are sitting on big gains, but we still believe that there is a lot that is yet to play out in this business and in this company. Next slide, please. So what are our portfolio construction dynamics? So typically, because we have a concentrated portfolio, we would basically invest minimum 5%, maximum 10% in any portfolio company. And that kind of makes that 12 to 15 stock portfolio. Again, this is very private equity like, where we don't mind if some of our winners become very, 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 heavy overweights in our portfolio. We have had situations where from time to time, some companies have gone all the way up to 25% of an entire portfolio. So of a 12 to 15 stock portfolio, you can imagine if one single stock has become 25%. But why we have the conviction to hold or be there is simply because not only it is about, the homework that you did while identifying or discovering an investment idea, we also very closely monitor our companies. And that's what I said in the beginning, you have to be on your toes. So you have the conviction to kind of, hold it there, because your thesis is playing out and you need to back your winning horses all the way. Two, as I told you, we don't invest in fragile balance sheets. To that extent, we also find that we are, very, very comfortable at a balance sheet level. So that's what, makes us hold that, even if it becomes an overweight. But once it reaches 25%, we kind of trim it down and bring it down to 20%. We don't invest, we kind of create that sector diversification, by investing a couple of stocks and not more in a theme, not more than 30% in any sector. And as I said, we do exit, but we have a phased exit. It's not exit and all go. And we do obviously, weed out our underperformers as and when warranted. Every portfolio would have an underperformers, as you know. Can we go to the next slide, please? There are certain stay away red flags which we have adhered to, and of course some of them after obviously learning our lessons. So we don't want to invest in companies that have kind of too centralized a decision making or a one-man show kind of situation. We do want to stay away. Every bull cycle brings some rock star, managements which kind of promise the moon. We don't want to. And what makes us feel that they are rockstar management, so to say, is that we find that they are disconnected from reality. They underplay risks and challenges. When you ask about them about risks, they kind of say, "Oh, this is not going to happen," and they are close to questioning. So then we want to stay away from such kind of companies, even though they may be a part of a larger macro which we like. A lot of times we find that there is a lack of focus on core business. Too early in seeing early success, some small cap companies start to diversify, their priorities start to shift. Accounting inconsistencies, numbers not tying up with the larger story. Oftentimes you see such companies and you say, okay, avoidable. Too many related party transactions make unnerve us. And of course, promoter share pledges, especially for purposes not connected to business, is also a very unnerving factor. Can we go to the next slide, please? Over time, we have also learned there are certain behavioral pitfalls which one should be wary of. So one is chasing momentum and losing sight of valuation. So there have been times when we've done all our homework and then after that, stocks have just run away. We couldn't buy. So one needs to develop that temperament that, okay, you will lose out on a few opportunities. Let's not chase momentum and just, buy at any valuation. Then, the other thing is this whole falling in love with a stock, the endowment effect, that you are invested and therefore, so to remain dispassionate itself is something which I think over time, it's been, we've learned. I don't know whether we are still there at that ideal level, but we've learned that, stay, be dispassionate. Let's not fall in love with us. There is also, we have suffered on account of decision paralysis, whether, waiting too late to buy or to sell. Over time, we have improved. We have improved a lot, but I should say that this is something which, one has to, in investing, one has to be wary of. Heuristic bias is something which, which it's not easy again, but we need to kind of, we within our team, we kind of challenge each other on heuristic bias, because you can be biased. I use a certain type of product and I say, okay, everything else is bad. So that's not the case. The market likes that, loves that product, and the product is going to see attraction, and I have to kind of stay away from my bias. So we kind of try to stay away. We challenge each other and kind of keep getting better at this. But I should say that it's never easy. And then, of course, there is this whole confirmation bias where you have a tendency to reject contradictory evidence thrown at your face. Again, these are things which are not easy, but you kind of learn over a period of time. Next slide, please. So here are the key learnings of our 9-year journey as a small cap PMS. First thing is patience pays. We need to be patient. This is not just about a private equity approach. Use any approach in small caps. Don't be impatient, otherwise, the results can be suboptimal. The biggest moat for any company that we find is its leadership and management team. Of course, you do your macros, you build a thesis, but whether somebody will be able to deliver the growth and the profitability that you look for, it only comes from the leadership and the management. Be humble. You don't know a lot, even though you think you know a lot. So always be open to learning. Like money, knowledge also compounds over long periods of time. So continue to learn, and that compounding of knowledge, the ability to analyze better, the ability to envisage and anticipate better comes. You keep becoming better and better with passage of time. Reasonable valuation is a function of quality of business and not an absolute multiple. I'm sure everybody knows about it. But when you say reasonable, when we talk of guardrails, as I said, you have different scores. So you have a cutoff score. The guy who's higher on the score obviously deserves a better valuation. Business fundamentals are often more important than macroeconomics and geopolitical developments. Time and again, we have seen that geopolitical, and especially as the world has become more and more volatile, we see that geopolitical developments come and go. A huge volatile impact is created on the markets, but eventually there is that phase passes, and good companies the good companies become better. So with passage of time. And lastly, very important is listen to your gut. So after all the logic and that you may have put, the data that have supported your logic, if still your gut is saying something is amiss, avoid if you have an alternative. Next slide, please. I thought, everybody who I speak to wants to know, what now? What are the investment themes? So maybe sometime I can spend here. Everybody knows of revenge consumption. What we do want to see is that revenge consumption married with long-term consumption trends. So some of the areas where we see, that theme playing out are listed here. We are anticipating a huge investment cycle in the whole global healthcare ecosystem upgradation. Once the dust of COVID and maybe this dust of the current geopolitical tensions in Ukraine, Russia settles down, the entire world, especially the democracies of the West, were found completely unprepared for the pandemic. And as a reaction to that, we anticipate that everybody will undergo the whole upgrade of their healthcare ecosystem. A lot of it will be based on tech, and that's where India comes in. So whether it is healthcare devices, whether it is diagnostics, whether it is healthcare analytics, all of it India will support. Atmanirbhar and China Plus One, combination of Atmanirbhar and China Plus One plays a very good place to play in the manufacturing sector. IP-led technology plays I have already spoken about. Green world theme is something which we believe is going to play out very well. Fintech powered financials, so financials everybody knows, but what is the differentiator going forward is going to be good financial place, but those who use fintech effectively for doing their business. And then there are certain post-COVID structural beneficiaries, your F&B business, your e-commerce platforms, your logistics, new age logistics companies. So these are some of the areas which I believe where opportunities will come from for future investing in short to medium term. Next slide, please. So short-term approach seldom works with small cap investing. This is just, imagine that you are driving from New York City to Los Angeles. You are in downtown Manhattan or Bombay, for example, hopelessly stuck in traffic, and bicycle messengers are whizzing past. You jump out of your car, sell your car on the spot at ridiculously low price, buy a bicycle, continue your trip to the West Coast. As absurd as this scenario sounds, investors do it every day when they make short-term decisions. Next slide, please. Questions.
Thank you, Sandeep. This was very enriching, and the evidence for that is the large number of questions we have got all through, since you started speaking. There are many questions which came in earlier, and then you covered them in the later slides. So, I'll bucket most of the questions in some segments, and I'll pose it to you. I'll take few more. I mean, it's already 6, but request you for some more minutes of your time in order to answer those questions. So one question which has come up a lot with a lot of the audiences, and I'll club 2 or 3 of them to ask you is, you mentioned about the thesis of, when the thesis plays out, then you exit the stock, right? Now, the point is that how do you identify, is there some kind of objectivity in the thesis? What if, you see that you might have a target price, but it gets hit in, let's say, only 1 year or 2 years because of the years like 2017 or 2021, when the small caps just, kept running up and up. And then there can be some scenarios where even for 5-6 years, you think that thesis might play out, but it hasn't. Would you want to stick around for more? Because you said that 5 years is almost the average time you stick around with the stock.
Very good question. And we do encounter these situations. So they are all real situations. So first of all, how we, so it's not just building a thesis on subjective. See, there is a thesis that okay, these things are going to happen. We also model them into, we create a quantitative model and we model them into, for a certain target company, what does it mean in terms of growth of revenue, growth of profits. And during this journey, where the re-rating can take this company to. So there is a certain logic that is built, and then that is every quarter, you basically, based on your understanding, based on actual numbers, you will keep tweaking that till, your thesis. So there are times when either for macro reasons, the thesis hasn't played out. So as I said, give 3 or 4 quarters, that much time we have to give to our companies. And we see that the thesis itself is not playing out the way you thought for whatever reasons. Then you will kind of, say, okay, let me gradually sell this position and reinvest in a better proposition. There could be reasons that of management. The thesis, the macro is looking good, but there is suboptimal execution on part of the management. Even then, you would want to exit. Now, situation is where the thesis is playing out, and I'm telling you that it is still not getting reflected in the market price. We will hold. Situation is where the markets are, they have gone berserk on the upside. And let's say, what you thought will happen in 4 or 5 years, the market prices are offering you in 18 or 24 months. In that situation, we do exit. We do take that exit call. We may not exit fully, but anywhere from 25 to 50% of our position, we do exit and lock the gains. And remainder we carry because we know that, the thesis is still going to play out. And therefore, one should. Now, do we face drawdowns for the leftover position that we have? Yes, we do face. But then, what we have seen is from the prices that we bought, more often than not, we have seen that, the price, ultimately, even after the drawdown, the prices that prevail of our investing companies have been in the positive territory, or sometimes, in a multiplier territory where you're, still 2 or 3 times up from what you invested in. So you're fine. So this is nature of the beast. You can't do anything about it. Typically, our investment horizon is 5 years. As I said, sometimes it is like 3.5, 4 years when you get, because your thesis has played out. Sometimes you have to stretch it to 6 years. We haven't really had situations where we had to hold any, we were holding any position for more than 6 years up until now. And reason being that that's long enough a period. Either something is wrong with the company. If the macro thesis is paying out, then something is wrong with the company. Or if the macro thesis is not playing out, you should anyway exit. So I don't know if I answered your question, but it is not that we are hard-nosed about holding the investment for exactly 4-5 years. We will make an exit decision if prices require, and the prices fly away and we have to, but it may not necessarily be a full exit.
Got it. No, that answers the question, sir. So that's thanks for that. So a very similar question is you mentioned that you mostly exit in a phased manner. Someone is asking, do you also enter in a phased manner where you might want to put some stocks in your market watch? I mean, you just track them and then later on buy?
Yeah. So okay, so there are two parts to this question. First of all, we don't have a model portfolio. We don't have a strategy. I mean, we don't have a approach where we just go and buy stocks. Somebody gives me a client gives me a check today and tomorrow it gets deployed. Because first is that there are guardrails. Every stock, there is a guardrail price. I think somebody asked a question, how we arrive at the guardrail price. Yeah. So I'll tell you. So guardrail price is arrived at by looking at the history of the target company, the peer group, the sector leader, and getting clues from the past as to how the valuations for this particular business has moved in different business cycles, in different market cycles. That kind of gives us some kind of a that gives a lot of clues about what would be a safe multiple or a safe band of multiple to pay to buy such a business, given the history. Then you also basically bases your understanding of the business and the whole 360-degree analysis that you do. You make a financial model, which is again a 5-year model because we have a 5-year holding. And giving the target company the benefit of growth and re-rating, you say, okay, where is it that after 5 years, if I want to sell, what is it that I can fetch? And then work backwards. If I want to earn my minimum targeted IRR, what should I pay today?
Correct.
Juxtaposing what came from the historical, clues that you got, and what you could arrive by discounting your future scenarios, you kind of then arrive at a multiple, and the multiple leads to a derivative price. Now that multiple remains unless structurally the business changes for better, then you may better the multiple after a few quarters because the structurally things are happening much better than what you anticipated, but very infrequently that happens. Otherwise, that multiple remains, and the price is a derivative of that price. And so now imagine a scenario in 2017 where the whole small caps were flying through the roof. For clients who we onboarded, it took us 5 to 6 months to construct those portfolios because most of our stocks were trading above our guardrail prices and they had to kind of correct and come within our guardrail prices for us to buy. Come today, when the markets have corrected in the recent past, so till 3 months ago, again, it was similar situation where, we did find that, we were taking almost like 2.5-3 months to construct a portfolio. Come today, a lot of our companies now are within our guardrail prices. So we still take about 4 to 6 weeks, gradually, slowly to kind of reduce the impact cost. You don't go and buy everything in a day. You still spread out the buying, but it's still taking us 4 to 6 weeks to construct the portfolio during these times when markets have substantially, the corrected and the valuation reasonability in small caps has come back. So it's basically driven by valuations and availability of stocks within our guardrail prices. We will not buy in one day, but it's not that we have some kind of a systematic buying plan. It is, depends on how the stocks are available within our guardrail prices and spread the buying to kind of, reduce the impact cost.
All right, sir. Another question which has figured out more frequently is that you have already shared a couple of success stories like Praj, Thesis, Intellect Design. I'm sure because in the small cap being the high risk area, there would be some bad Rotten Tomatoes as well. I mean, can you share some couple of stories as to where your thesis
Sure,
went
sure,
wrong? And then how did you exit? How did you identify early and then exit?
sure. So we have had our share of, I won't say rotten potatoes, but underperformance. And why not rotten potatoes? Because honestly, we've not had a lemon in our portfolio so far where we had to be, there was an egg on our face as to why did we buy this company. Somewhere I think that this whole, approach of research and the whole private equity approach, along with not buying a fragile balance sheet, has helped us not getting into those situations. However, we have had underperformers. As I said, underperformance can be of external macros or can be because of suboptimal execution. So here in this case, I won't name the companies, but I'll give the flavor of some of the underperformance. So we invested in a auto ancillary company, which had we invested because we clearly saw that this this is not going to be impacted. This business is not going to be impacted by the advent of electric vehicles. It actually may get a slightly, it can get, the outlook can get slightly better with mainstreaming of EVs. Now this company had overseas subsidiaries, one in Indonesia and one in Brazil, which where there was significant business, and we kind of relied on management representation that the Brazilian subsidiary, which was making losses, we are selling out, and therefore and we have engaged an advisor, and in 3 quarters this will be sold out. So what we did is, in our modeling, we kind of wrote off everything. We didn't expect that the company will get anything from this subsidiary, and we basically modeled that on this basis, writing off all the investments in the subsidiary, what could it look and give growth in other markets, including India. And India was indeed growing well. And by the way, even today, we exited about 2.5 years ago, but even today that Indian part is growing very well. Now, unfortunately, we didn't we do this whole validation of our investment thesis by speaking to the whole ecosystem of business, various participants, some dealers, distributors, suppliers, customers, every lot of. We couldn't do that for the Brazilian subsidiary, which was a material subsidiary, and we had to rely on management representation. 2 quarters passed, nothing happened, and what we realized is that the company, now the parent company, is pumping more and more money into funding the losses of the Brazilian subsidiary. So much so that, and then there was some strike in the subsidiary, they had to move the location. We realized that there is no way we can model this, there is no way we can validate this, we should get out. So we got out at a slight loss because the stock had run up, because all the Indian operations were done up. We couldn't get out. If we had the ability to validate what's happening, we could have gotten out at a good profit, but that profit got all eroded because we gave the management, and that their management representation was there. So we gave them almost 3 or 4 quarters, and in 4 quarters, the story changed. That okay, there is a sinkhole there where the company has to continue to pour money. So you make money here, and you kind of put money. The other, one arm is making another arm is kind of sinking the money. Another one where we exited was again, this company post COVID has become darling of the markets. And darling of the markets means they have really done well, and we like. So there is no governance issue or anything which made us. This was a company which basically was into Indian liquor, the branded Indian liquor, had 2 states they were present in, and there was a 3rd state which they were entering, with they had already set up the facility. So the growth was coming from the new state, which was a large state where they had all the approvals, their distillery had come up. And what we liked about this company is that they had one of the best balance sheets amongst the entire industry, including the multinationals. They had absolutely very, very minuscule debt. Erstwhile, they were private equity funded, so the governance structure was good. But when we invested, after 3 months, this whole, the new state, the business was to go on stream, and the sales were to start. because we invested when the capex cycle was just about getting over, and the business, the commercial production was about to start. This state, after a new elections and the government came into power, they announced prohibition. So the state was Bihar. Now suddenly again you have an external environment where you don't know where the growth will come from. Already the capex has been done, and you can't sell your product in the state. Again, we can't model this, so we had to kind of exit. So one side, I would say the first one, former one, was where we exited because I would say bad execution. You had your subsidiary which you couldn't control, you made representations. The other one is where it was an external. So we would have had a few more such instances along the way, but all of them either external environment changing. So for example, we were invested in one industrial company where there was a feud between the two promoter brothers that happened. It's a well-known feud. So, and that we thought it should get resolved because we were kind of doing some channel checking, and we felt that there are some beneficiaries of both the brothers were trying to kind of. And by the way, company is not getting impacted because the company is professionally managed. But then COVID happened, and we suddenly realized that, okay, this also is a business which will get impacted, if not in the long term, but definitely in the medium term. So that kind of prompted us that there is already a feud followed by this impact, so we should exit. So exit decisions of underperformers have been triggered by, except for this one brothers feud, by either external factors or internal suboptimal execution on part of the management for us so far. I'm not saying that in future we may not have a rotten egg.
Part and parcel of small cap investing.
It's a part and parcel of our investment.
Okay, so another few questions are regarding how do you identify or screen for the tailwinds in the sectors you can probably say, or what's the technique to conduct research on the ground?
So one, that we have this whole advantage of both me and my partner coming from the private equity legacy that we have. Large part of our lives we did private equity investing. So we have a very strong connect with the private equity fraternity, even very much, so that's where when you network there, you get to know a lot, early trends, what is happening, what's changing, because those are the guys who obviously, invest for future growth. So, and then of course, a lot of them are also in the VC fraternity where, the disruption, what is happening, what. So I would say that it's a temperament that you think, you start to think, then there's a lot of deliberation that happens within our teams. And we do a lot of reading, which is really not financial. It is more, conceptual to what's happening. It's also a lot of it is global. Like, for example, plant proteins. Only recently in the last 3 or 4 months, one of the companies has got funded in the private VC space for plant proteins, and followed by that, couple of more transactions have been announced. But we have been kind of looking and reading this for last 6 or 8 months, and we have we have gained, I would say, a good enough understanding of the whole value chain and who are critical, for the success of the industry. Who are the critical people in the value chain, and who's going to also clearly going to get impacted once this mainstreaming continues. So it's about spending a lot of time beyond the normal research that you do. I'm not saying we don't do that. We have the databases, we run the screeners, we attend calls, but you have to slice some of your time to do, go beyond. You also, you keep meeting people, a lot of our time goes in meeting people who are from the startup space, who are doing something innovative, or who are from the companies that have grown, now being funded by private equity, but they have a lot of innovation they have brought into their businesses, and that gives you a lot of clues. That gives you a lot of, and then within that, then you say, okay, can I find something which is available in the listed?
Exactly. Okay, so I have few more questions left, but then two members have raised their hands for a long time. I'll request if they can just unmute themselves. So Guneet, if you can unmute and ask the question, and then after taking these two questions, I'll again come back to the text questions, sir. So yeah.
Guneet, you have to unmute yourself. You're still in mute.
Amber, you can go. You can try if it's possible from your side. Okay, just type the question. So I'll take. I'm anyways taking all the questions over here. So. Okay, I'll move ahead, Sandeep. So there are some standalone questions as well, which you can quickly, kind of answer. So you had on a slide. Yeah, Amber.
Amber, you are in mute.
Yeah, just a second, sir. Just a second. Yeah. I just wanted to ask regarding. So you said about the failed investment. That was very good to hear that how you made an exit. What are your filters when it comes to some financial numbers? So basically anything related to market cap or maybe somewhere related to PE ratios or some cuts on that, or it's not nothing related to the financial filter?
No, it's absolutely related to financial filter. See, everything, gets converted into numbers at the end of the day. My today's presentation was less on numbers simply because I'm sure all of you would have heard enough about numbers and data. So, the exit is driven by, if you're talking only about exit of underperformers, then that is driven by certain events. But otherwise,
I'm talking from both. I'm talking for both. When you decide to enter into any company, right. Generally in small cap space, you want to know that what this is the minimum market cap wherein I would invest or something like that.
Right. So minimum market cap that we look for is 500 crores. We will not invest in a company less than 500 crores. Our universe is 500 crores to 5,000 crores at the time of purchase. This is the typical universe I'm talking about. Average entry market cap is about 2,800 or 2,900 crores today when we invest in a company. Exits is definitely driven by numbers and multiple. So the multiple at which we want to exit, when we have invested, even that time, we plot the future and we have a kind of what we call a guidepost that if you hit this number, you should consider exiting. However, with the passage of time, as the company and the industry evolves, you may tweak that number to kind of, sometimes you may because you are conservative when you build your projections, but as the things plan out, so take for example alkylamines. We were invested in alkylamines and we had an exit price of alkylamines. We eventually exited at 3 times that price, so we kind of made some 11 or 12x. But why? Because structurally the industry as well as the company kept on getting better, both in terms of growth and the margins that it churned out. It was much better than what so it is driven by numbers, but it is where the numbers are coming from and why they will come from or why they will not happen is something which comes from your channel checking and your interacting with the business's ecosystem.
Okay, great. Thanks to hear that.
Thanks, sir. Thanks a lot. So as I was mentioning, Guneet, you can also try whenever you can unmute yourself and ask the question. Till then, I can move on to the remaining questions in the chat box. So you mentioned in one of the slides about the decision paralysis, right? Then you're always looking to improve the decision paralysis. So Molly has been asking that how did you improve your decision paralysis? How did you go about that?
So, the decision paralysis happens because this is something which is also linked to bias confirmation. You had certain experience earlier. For example, you bought a certain business at a certain valuation and it worked very well for you. So the decision paralysis could be, oh, this is a similar business. I bought at this multiple. So why should I pay a higher multiple now? Now, have you done enough homework around the business, Have you also done enough homework around the structure of the business? Sometimes, you kind of make it very straitjacketed. It's never. So you get out of the decision paralysis again by subjecting yourselves to or by being challenged. Allow others in your team to challenge why I should be paying this a higher value or why I should not be paying a higher value. So if suppose in our case, we when we sit down together, sometimes we have very very intense arguments where each one needs to defend why are you asking and why I should be. See, that's the only way to come out of decision paralysis. That you discuss and you kind of be open to looking around. Go again if you have if you are biased, go again and do a recheck and then say no, it makes sense to kind of change your decision. Still never, I said it's never easy, but you need to continue to work on it. You need to kind of continue to tell yourself that let me not be stuck in my head, let me be flexible, let me hear. And then in the end you have to take a decision. See, at the end of the day, not taking a decision is not good. You take a decision, stick by the decision. Otherwise sometimes what happens is you didn't buy something and that ran away stock, then you get into that missing the bus feeling, which is not good. You took the decision, there was all the rationality around it, and then you basically you have to live with that okay, in your life you will not get everything. Some certain things, certain of your ideas which you worked on, you're going to miss. That's fine. You'll get the next one. So that's what I mean by decision paralysis.
Okay, thank you, sir. So we come towards the last question. A couple of guys have asked that is there any books or videos you would recommend for the small cap investing? I know you have already shared your wisdom of nuggets of wisdom, but if there is any book you would want to suggest, then
at least I would say that One Up on the Wall Street is a good book to read to start. It's because it gives a lot of insight into how you go about interacting with any business's ecosystem, various participants of a business's ecosystem, to build a strong investment thesis. Otherwise, there are no books. It is all about temperament and it is all about the effort. And trust me, when I say 30% desk and 70% on the ground, that's the key.
Agreed.
Numbers are important. Numbers are given. Numbers are available. You need to go beyond the numbers.
Yep. So that brings us towards the end of the questions. Thank you, sir, so much. Thank you, the audience, for asking so many questions, listening patiently for over 90 minutes now. As a reminder to all the listeners, please do complete the evaluation survey that you already would have popped in on your screens. That and the CFA Society India members can also claim your professional learning credit by logging in their professional learning tracking tool. Thanks, everybody. And I would just like to highlight the next session, which we are going to have on 10th of April, our beloved box cricket for the Mumbai guys who are over here. Anyone who is traveling to Mumbai obviously is welcome. This is only for members. So do look for the emails in your inbox. We have already sent out the links and all to register, and look forward to your participation for that as well. Sandeep sir, thank you so much once again.
Thank you, Vaibhav. Thank you everybody for being patient I have extended the time. I think we were scheduled for an hour, but thanks.
Worth it, sir. Worth it. Completely worth it.
Thank you. Thank you, everybody. Goodbye.
Bye-bye.